to recognize that interest rates affect not only the wealth you're working in, but they also affect the wealth you've built. And I didn't consider those things at the same time. I thought the leverage I had in my personal wealth portfolio in real estate and the stuff I was investing with all those other properties, this would be able to protect against any sort of minor losses here. And I didn't expect, if you lose $100,000 over here, that was like the expectation. Worst case scenario, let's say a project blows up and something goes really bad. I'll just tap over here, fix this, and then, keep rolling, because I've had a lot of success, not many failures until everything literally went kaboom at once. And I kind of got myself into it because I didn't think I could lose. You kind of build over 4 or 5 years, everything's smooth transactionally. I've helped.
Welcome, millionaires and future millionaires. You're listening to the Millionaires Unveiled podcast, a show where you'll hear the stories and interviews of everyday millionaires. We'll unveil their decisions, their strategies, and their portfolio allocation. Now to your host, Jace Mattinson.
Welcome back to another episode of the Millionaires Unveiled podcast. This is episode number 370.
This is the podcast where everyday millionaires spill the beans on their stacks of green. We're your hosts, Jason and Stacy, ready to bring you the unscripted tales of wealth, warts and all, because who needs a script when you're rolling in dough? Join us as we dive into the net worths and asset allocations of regular folks turned financial titans. We promise our only edits are to be kid-friendly, so you won't hear any naughty language, just a lot of cha-ching and a sprinkle of do-re-mi. So buckle up, tighten those purse strings, and get ready to laugh and learn with the Millionaires Unveiled.
Man, summer has flown by. We just finished the Olympics, and the Paralympics are about to start, which, yes, for those that have reached out, my sister did make the team, so we will be celebrating with her and watching her run. Appreciate all those who have wished us good luck, and a few of the international listeners that have reached out in particular on her heading to France. So, man, summer has flown though, and I feel like this time of year is, and I don't know if it's because you got to get file taxes, you file an extension or whatever, but there's always a time that I feel like we take another look under the hood on various financial aspects of our lives, whether it be different investment strategies or just kind of getting set up for crushing the end of the year, and also what the next year, in this case 2025, may bring. But I usually spend a little bit extra time this time of year myself, and I know a lot of people do. I think it's part of just getting back into kind of the school routine and just getting into fall. But I'm extremely excited for it this year. Today marks episode 370, which means we're not that far away from episode 400. And as keeping with tradition, sort of, 300, we were a little off, we're a little late, but I'd like to throw it out there. If we can get a guest worth $400 million to come on for episode 400, I got to get the call out early, because sometimes it's taken us a few months to track somebody down, but it'd be pretty cool. This one might be a little bit of a stretch, but would be pretty fun to have somebody on worth $400 million for episode number 400. So if you know anybody, or if anybody listening to the show right now fits that, reach out, millionairesunveiled@gmail.com. Also, if you're an everyday millionaire and would like to be on the show, we always look for new great guests, new professions we haven't heard.
I feel like we're more likely to have the assistant of someone worth $400 million listening to the show than maybe the 400 millionaire, but we never know.
Hey, look, I got somebody coming on here pretty soon. He's not 400, but he's up there. And yes, I did correspond with his assistant. I mean, he and I texted back and forth a little bit, but yes, I did things through assistant. Had he not had a baby recently, he probably would have. But yeah, the assistant of, or executive assistant, or somebody, or whoever works with the schedule of somebody worth 400 million. Got episode 400 coming up early next year, and would be kind of cool. If not, we'll figure out something else if we can't find somebody or track somebody down. But I got pretty lucky. I mean, in fact, episode 200, he was actually worth, I think, 300 something at the time, but he said he'd come on for episode 200, but he's probably actually worth triple that now. But maybe he'll come back on. He's a cool guy, and has recently moved not too far away from us. So with that, today's guest is Jordan. It's kind of a unique episode, actually. I think we only had one other episode like this ever on the podcast, which I think was one of the first 5 or 10. where this individual, and this is the case today, his name's Jordan. He was worth $2.2 million, not even just a few months ago, but he lives in Canada, and due to kind of the interest rate rises and stabilization, his properties basically became worth essentially zero, or the equity they had in them was worth zero because the properties were worth basically what he owed on it. So he went from basically 2.2 million to, as he says, zero overnight. So I guess technically he's not a millionaire today, was a millionaire maybe when we even recorded it or right before we recorded it when he first wrote in. But I still thought it was applicable to put out there. Many good lessons to learn from what he has to say. And also, this is something that I think probably a lot of Americans, or at least a lot of people that live in North America, may not even know about Canada, is they have a similar AM schedule that we do with real estate, but they don't lock their rates in for 15, 25, 20, 30 years like we do typically in the United States. So it's more of kind of a commercial we do that in kind of a commercial environment sometimes in the United States, but residential we don't. And in Canada, it's kind of more of that commercial. So, you figure somebody did a loan in 2019, as Jordan describes, that has come due in 2024. And, the property is not quite as valuable, but values compress quite rapidly. So most of it was in real estate, but as he describes, he sold a lot of those properties in recent months to try to get out from under them and effectively start back over. So going to be an interesting episode with him, somebody who is a millionaire and then went down to effectively zero and is on the way back to millionaire status again. So without any further, and he is a real estate agent too. Ironically, he is 50-ish miles away from some of the border towns and cities in the United States. But when we talk about what it takes to become an agent in Canada from a professional standpoint compared to what it does in the United States too. So without any further delay, let's get right into episode with Jordan.
Jordan, do you want to just give us a little about your background and what you're up to now?
Yeah, so been a realtor for 16 years, actually, just as of March 4th. So that's kind of cool. My dad was in the business since 88. That's how I kind of jumped in my youth there. Then I got into investing around 2019, built a fairly good investment portfolio, and then had a bit of an adjustment in the 2022 change of interest rates, which really affected us up here in Canada a little bit more, but been a realtor again. That's been my primary business. Back to that is my primary business, helping families and helping investors, continue to build wealth and in their futures. So it's a really cool place to spend time and enjoy being in the middle of people's families when they're doing some of their biggest, financial purchases in their life. So
yeah, and we're going to get into the details of your career path and everything that you've built over the few years. But before we do, what's your net worth today?
Net worth is approximately zero, probably today. Yeah.
Okay. And before it was zero, too long ago, what was it?
2.2 probably was a approximate net worth. So it was a very massive adjustment. Most of it predicated on everything in equity falling by about 30% in my world. So
walk us through that a little bit. I mean, was everything essentially in real estate then, that 2.2?
Yeah. So most of it was, I had a few things out in other arenas, probably only about a couple $100,000 in let's say other assets that were outside of real estate itself. And then, a few other $1,000s in cash. So probably about $1.8 million was held in equity across properties and through that metric. And so again, I own probably $6 million worth of real estate, but that's where you have and only owed, call it 4.2. And then the market corrected for 30%. Well, 30% of 6, 3 times 6, 1.8 million. So it's not exact math, but it's relatively in the ballpark of exactly how I went from feeling like, if I probably liquidated every asset I owned and cashed out, I would have had approximately $2 million probably in my hand, to it just evaporating based on interest rate adjustments and our market correcting from an average sale price here in Windsor, Essex from 732 down to about 485. Today we're at about 580. So we have recovered about $100,000 of that then, but it's when you're in the middle of the adjustment, and I was actively investing with 7 of those properties were active as the market crashed. So bought just as the peak was hitting. And then as we went down and had to deal with that in real time. And so with that, plus my primary residence and my other assets that I held, most of them all fell within value. And so to try to cover costs and do all of that, I had to liquidate pretty much everything I owned. I still own my personal residence, but all the other real estate is gone, to kind of get myself hopefully to as close to net zero as possible. Right. And so then from there, refoundationalize, rebuild, and get my feet back on the ground. I have my real estate business, which is still, generating an income, doing, the thing to provide for my family and take care of that. It's just, it was definitely a massive learning curve. I'm going to take it as a massive payment of education, to recognize that interest rates affect not only the wealth you're working in, but they also affect the wealth you've built. And I didn't consider those things at the same time. I thought the leverage I had in my personal wealth portfolio in real estate and the stuff I was investing with all those other properties, this would be able to protect against any sort of minor losses here. And I didn't expect, if you lose $100,000 over here, that was like the expectation. Worst case scenario, let's say a project blows up and something goes really bad. I'll just tap over here, fix this, and then, keep rolling, because I've had a lot of success, not many failures until everything literally went kaboom at once. And I kind of got myself into it because I didn't think I could lose. You kind of build over 4 or 5 years, everything's smooth transactionally. I've helped clients build for 15 years at that point, or 14 years at that point. So it wasn't like we'd been working through things and building. And so all of a sudden, this is the first time in that arena where everything's shifting again for a lot of us who are young, right? Like, if you were in the business in '08 and doing it, you were investing from, 2004 to 2000. I'm sure you felt a major shift there. If you were in the 90s, right, 89 and 90s, the early part there, you would have felt it then and older. But of course, this is my first experience really understanding it, because I did get some advice from the old wise owls that were around saying you might want to be a little careful. Things are probably not going to continue forever, but they'd been saying that for 3 years, just so we're clear. It wasn't like that they said it in January of that year and it magically came. They just were being more cautionary because they've already felt what I'm feeling now. And now, of course, in retrospect, I'm like, yeah, should have listened, right? So,
yeah, that's interesting. So, and one thing I want to note for our listeners, and I'm not sure, this was kind of new to me, and you can probably explain this a lot better, but for most real estate, especially residential in Canada, I mean, you're on essentially 5-year terms, not a 30 that we would typically see in the States, or 25 or 15 even. You're on a 5-year max, correct?
yeah. So a lot of real estate in Canada is we run on a 5-year fixed term on a 25 or 30-year amortization. So we still amortize the debt over the same term. We just don't get locked into the rate. And so what we're seeing in Canada because of this, of course, is if you locked in 2019, right? We're in 2024. So the 5 years is coming up. You probably locked in right around between 2.49 and 3% then. Well, now interest rates are 5.249, or like they're 5.25. So you have to understand. So you're almost doubling and sometimes over doubling the interest on the payment. And so you have to think that for a family, unless they've generated that's a $600, $700, $800 a month bill that's now coming just because they're renewing their mortgage. And so the only benefit is our equity platform is way up. So basically we're at 550, give or take right now in our average here, but you probably bought that house in 2019 for, let's say, 380 if you're looking at the same math to math. So there's a lot of equity in the home, but what are you going to do? You can't, you need to live somewhere. So again, we're looking at refinancing, pulling equity out to deal with the current interest rates till we can hopefully get them back down to that 3.5 if they ever get that far down. We need them to drop about 2%, because if it went up 1%, most people would be like, oh, 1%, yeah, it sucks. But that's probably $150, $200 a month payment. You could probably find that somewhere in your budget to make that work for most families. Maybe you just can't go to Disney like you've been doing for the last 5 years. You can't do that now. You could pull it out. But when you're talking about $600, $700, $800, $900 a month, like how many families can just find that money, scrape it together with a lot of people who work paycheck to paycheck, hour to hour? It's really stressful. And so we're trying to come up with really good ideas for a lot of them. Right now, it's like, hey, do you like, I know you like your privacy, but do you have an extra room in your house that you can put a student in? Because again, there's at least $600-$700 you might be able to get out of that room that helps you offset your costs. So we're looking at those things from the economic situation. But yeah, when you're looking in the States, the benefit is now you guys have the other problem, which is nobody's moving, because I have a 3% interest rate. Right now, I'm going to get an 8% interest rate. I'm not going to sell my house and move. I'm not going to do anything. Yeah. I'm going to keep this forever. And so there's a massive amount of stagnation. Somebody said, and I just want to be clear in here, but just today she says in the US, the only 61% of the active listings are divorce. Because the only reason why most people would be moving in the US, because they have such good interest rates and they've locked in for 30 years, would be on the premise that they have to. Very few people are going to be moving unless, of course, they're moving for work or some other reason. Very few people are likely going to be in transactions right now when you're going to try to move up, but you're going to add 5% to your mortgage. How do you make that make sense, right? Based, on the whole and all of those things. So again, I've talked to a lot of American realtors. We were just at a big conference there. So trying to balance between the countries, see what's going on, trying to understand. But yeah, Canada is a different animal. So we have an active market, but when the interest rate adjusted, it affected our value much more quickly. And I've talked to a lot of Americans. They're saying, yeah, no, our values have held pretty strong, but nobody's moving. We have no transactions have fallen off a cliff, right? And so that's just a different problem when you're in the active business of selling and helping people buy and sell real estate. When the transaction level falls, so does your income, right? So
yeah, how does that affect rents where you're at?
So our rental market, it continues to climb. We have I think the US, most of the US, just like most of Canada, we seem to have a housing shortage somehow. Like they can't build enough units. So we're in this situation where we don't have enough homes for the people we already have. And our immigration policy in Canada is even more aggressive than in the US is per capita. Like for the amount of people we have in Canada, you guys are 10x us. We bring in like 1.5. Their objective is to bring in another 1.5 million people to Canada, but we can't house the people we have now. So I'm not sure how they're expecting to house this next wave of people because we're just not building nearly enough homes. I think we're talking about a deficit of almost probably more than 1 million homes a year that we're in right now compared to construction versus need. And so again, we're seeing our rents climb because of that. So if you want to rent a 3-bedroom, 2-bath house in Windsor, Essex right now that's got a decent yard, decent neighborhood, you're probably $2,400 a month.
I want to ask just because I feel like the dynamics between US and Canada, people just aren't quite as familiar with, and it's like we're neighbors. I mean, we're very close neighbors, but one of the major things that happened in the last, I don't know, maybe quarter century in the United States just happened in the last few weeks here with the ruling on real estate commission. Is there anything like that pending, or is that, does that trickle down to Canada, or is it, hey, I'm a realtor in Canada, my commissions, and structure is not really at risk the way that all of a sudden it became that way in the United States?
Yeah, so Canada, like our banking system and most of our systems, we're much more, what's the right word? They're just different. You're more the Wild West. You guys shoot from the hip a lot more than we do. We have a lot more systems and models in place that don't really allow as easily for the amount of change that can happen when a law like that changes in the United States. Like when you consider, so there is a lawsuit happening in Canada right now trying to do the same thing, but we have more structure. Like to become a realtor in Windsor, like in where I am, it takes 2 years. If I cross the border into Michigan, which I can be there in 10 minutes, it takes me a weekend. Like basically, it takes 2 years to get your real estate license in like in Canada or in Ontario. Different provinces, of course, have some different rules, but overall, they're under a more generalized function when it comes to these things. Like we have CREA that operates like your NAR does. And so NAR is the one who paid out, but Keller Williams also paid out. So did RE/MAX, so did Century 21. If you actually look, a lot of them all got sued in different ways. And I think Keller was sued for $1.3 billion. And they ended up selling for, I think, $77 million, that lawsuit. But it all came down to lack of paperwork, lack of disclosures, lack of that. Now, we've had massive disclosure, massive stuff in our paperwork for a very long time. So in our function as realtors up here, we just have a more, we have to be more upfront about exactly what we're charging, when we're charging it. It's all built into the forms. It's all written in. So like I sign a buyer rep with you up here, it says what the commission is. Now, usually the seller pays me that commission, but it's written into a form that you're agreeing to. And the general understanding is we just accept whatever the MLS commission is towards us. So in the United States, I don't 100% understand because, again, we function so similar. Like we show houses, we sell houses, but you have title companies, we have lawyers. Some states do have lawyers that I found out. I didn't know that. I know Ohio and I know Michigan kind of well, like because I have friends who live in both places. So I've talked to them. Of course, as the realtor, they'll sometimes chat with me about their experiences. You have home warranties over there. We don't have home warranties up here. Like that's just not something we really deal with. They've tried a few times. So again, when you're looking at the NAR thing, they are attempting it up here, but I was talking with some of the guys who've been in the business a long time, and they're really saying that in Canada, it's unlikely. We just actually came out with a whole new buyer function where we can't even do customer service. You're either represented or you're non-represented. There's no in between anymore with what we did because we just rewrote most of our law. And in that says unlikely that this would be another thing they're going to add to it. And basically, it just allows you as a consumer, my understanding is to basically a la carte your buyer agent. But here's the thing. So every house you show, like a lawyer, right? A lawyer, every time you send an email, every time you make a phone call, every time you act in some way to your benefit, they charge you, right? So if I want to message my lawyer, he's going to email me back, and odds are that's going to be on a bill somewhere at some point, right? I'm going to make a phone call. There's going to be a bill line somewhere for that. And I don't think that the industry itself will actually want that, because I don't think buyers want to be the ones on the hook, even though they pay it in the closing, right? They pay it as like they're paying the seller all the money for the house. The seller's agreed to pay the commission to the realtors. So that's already been built in. I don't think the a la carte thing is going to be for most people. I just think I think the talking heads and the people who think they understand the function of the business are trying to make changes that won't hold up, because people won't really want to adapt to the new. They'll want to do things the way it's always been done. Realtors won't want to do it. And I think most buyer customers are going to want to do that. But for those that don't, there's now an opportunity where you can have a different disclosure, and there'll be discount people out there doing all the same things. But we've always had discount brokerages and discount people and things like that. And there's nothing wrong with them. It's just different service levels. You can go to one one mechanic who's going to charge you $65 an hour, one that's going to charge you $85 an hour, one that's going to charge you $125 an hour. You can go to a lawyer, $150 an hour, $250 an hour, $500 an hour. Realtors, same idea, right? You can pay for the person and the value you see in them more readily. And I think that's what they're trying to accomplish. But I don't know that, again, moving an entire industry in a moment and thinking this is going to be earth shattering and save $30 billion in real estate commissions or whatever number it put in that paper, what I was reading, I'm like, I think it's a little overshot. I think it's going to wash away, and like the lawsuits will happen. I think they'll have a lot more paperwork. I think there'll be a lot more disclosure in the United States than there's been. That's where I see most of that all coming out. But I think the function of real estate will actually stay pretty much the same, both here and in the US.
Yeah, it's an interesting thing. Appreciate you sharing those insights. So I want to go back to these properties that you ended up selling.
Mm-hmm.
Were they single family rentals essentially? I mean, were you cash flowing at one point, and then just because of the equity loss, it was like, hey, I got to cut my losses and get out of this quick? Or kind of walk us through that journey of liquidating all of those assets.
So the first step was so we'll go. So from 2019 to 2022, I did wholesale deals. I did I did the buy, renovate, refinance deals. I did a bunch of different deals to get some assets in my portfolio. And then in 2022, we decided I'd bought two in February by myself. So I was just continuing. I was going to do two projects. I had one of my crews going to work on one, but they're both closing within a couple of weeks. So I went to get a secondary crew. So I reached out to one of my buddies to see if his crew was available and whether he could quote the job and just have his crew come in if they weren't working right now. And so then when we did that, what ended up happening was he says, well, why don't we partner on this one? So then we brought our resources together. So we decided, basically, we went into a marriage together and said, okay. And then we amplified and we bought 5 more within the next couple of weeks. So basically from February 27th through April 15th of 2022, we ended up buying 7. I kept one external. So I had one that wasn't involved with him, but all the other 6 were. And so then, of course, we see the first interest rate tick, right? So we see the first, it went up a quarter. We're like, okay, they said, Bank of Canada had said they're going to raise it by 1% by the end of the year, which is, so I built in a 3.5% interest rate adjustment. So when I'm going to refinance some of these and do those things, that would be, instead of using 2.5, use 3.5. I built in a 23% fallout rate, meaning that if the market, if there was any major shift in the market or something did happen, I had 23% to give. So I built in all these metrics that I thought made me invincible. Like I just did. I'd built over all those other years, this model that seemed to work and just kept turning over. So then amplified. And so we leveraged about $4 million in that moment to buy all those properties. Well, then by the time we were closing most of those properties, so 2 closed in March, but the rest, 3 closed, 2 in June and 1 in the first week of July. And then we had 1 closed mid-July or end of July, and then 1 we actually wholesaled out in September, and we didn't close that deal. But the problem was we had to take on all of this debt, and we already knew we were underwater. So we ended up renovating, holding, and flipping, and basically selling them for almost exactly what we'd put in. But you got to remember, after you renovate, carry the cost, because we're using other people's money at 1%, and all those things, almost 3 or 4 of them are about $80,000 losses. Pretty quickly, right? And so then you have all this money. So those all we decide to liquidate because we're looking at it going, we don't know where the bottom is either, right? Like we didn't know where the catch was going to be. Because there were some people saying our average might go to 400, which would have been almost half. And if it did that, like we would not have been able at all to get out. But we also figured if it did go that low and if we liquidated, we could buy back in and hopefully kind of make back the difference because of the way it would have worked. So we made the decisions and we liquidated out. We basically were able to close, get out, but by then we'd created basically a $500,000 loss. Well, I have my assets over here, but all of these assets that were worth a lot of money, like my primary residence and other things, they all fell in values too, right? So when I tapped to try to find the money to fix this problem, there was nothing really to tap. Like there was some money in there. Don't get me wrong, it wasn't completely empty, but nothing like what it was when I started the process. Like I said, that when I bought those 7 and when I put the value of those plus this, even just the asset hold of that real estate was worth like right around $2 to $2.5 million, depending on what you looked at. And then by the time I was able to liquidate and get out and liquidate those assets, it basically all became a wash. And so basically I ended up net zero in that process. And then that's where you're standing. Now I have my leverage back. I have my partners. We're all ready to do things, but because our market's been highly stable, a lot of the model that I had, and there's a bit of trigger shyness. I'm not going to lie. Like it's not as easy to pull a trigger when you're standing there going, well, the last time I did this, look what happened. But at the same time, I'm not fearful in the sense like I wouldn't do it. I just have to find a good deal. Like it has to, I'll say this, it actually has to be a great deal. I'm not looking right now. I want to get my feet wet, but I want it to be a great deal where the loss is either very highly mitigated and or non-existent. And so that's what we're looking at right now. But that's how I got myself from wealth to no wealth and it being an equity play, right? Like you lose 30% in your primary residence and you're using it as a bank, right? So again, not the greatest of ideas. Probably will not do that again. I probably will never put my personal wealth up as collateral against what I'm doing over here. The leverage over here will be independent and I'll have to keep my mindset separated because I put my family in a really bad spot personally, and that's not something I ever expected to do or ever wanted to do. And I did say before I ever started investing and doing this with my wife, and we had a conversation, said, hey, if I'm like, because I didn't know at that time whether or not, you never know what's going to happen. I said, are we okay? Will we be okay if I have to, go bankrupt or if we have to lose what we have? And she says, yep. So then it gave me the freedom to go do things. And I never intended, just so we're clear, it's good. My wife said it was okay. Like, no, but I am very grateful to have the support of my wife. Like, of course, she's not happy per se in the moment. And I don't think that's fair. And she's not, I could have made different decisions and I put us in this spot. That's on me and I'm owning that. But at the same time, she knows I didn't do it with any level of maliciousness. My investors know I didn't do it with any level of maliciousness. It's just the circumstances that presented. And I didn't know how to make better decisions. I could have, like in hindsight, liquidate all of those to wholesale immediately in April. As soon as I've got them all locked up, immediately put them all up for wholesale just liquidate them all for whatever I've got into them. Then they would have been gone, right? Because I could have possibly done that, but nobody knew what was happening. By the time I caught on that the market was falling that fast, we lost 7%, 10%, 12%. By the time that happened, that was 3 months. I didn't even close on 3 of them. So you can't really, and in every month you're like, okay, have we hit the bottom? And then finally it's like, okay, this was a ride I wasn't really prepared for. And like I said, I've learned from it. I'm going to take the learning. I'm going to let go of it took a little while to let go of like feeling like a failure, feeling like I'm worthless, feeling all of the emotions that are going to come. But the people around me, which is what I rely on, is my relationships. Those people surrounded me and they didn't say, hey, you didn't make a mistake. They just said, hey, you're still worth it, man. Like there is still value. Like you've done something. Yeah, you made a mistake. This happened, but there's still value. And that was so huge. Having the relationships around me, my wife, my kids, the things around me, my partners, and some of them got hurt, right? Like it wasn't like, everybody's involved. It wasn't like it was just one person along the way. There's a few that are getting hurt in this, but all of them have had compassion and care in a meaningful way. And not to state that they're not, that they're happy, but they're also understanding it wasn't I didn't like Ponzi scheme it. I didn't do anything to make this happen. It's just, you gambled with me and I didn't realize I was truly gambling. I thought I had a really solid product, and that's my own hubris. My own hubris put me into that. And today I stand in a lot of humility and went with a lot of humility, owning the decisions, owning the reality. And I think that's the biggest thing that helped me get through it, was just owning the fact I made a mistake, and that's absolutely okay. And I have time, energy, and I'm going to bring all of that back to really help everyone who is involved rebuild their wealth, rebuild their positions.
Wow, what an experience. And thanks for being so vulnerable and sharing that, because it's a lot to share. And I'm sure there's a lot of pain and emotion that kind of goes along with that. I mean, it's at the end of the day, it's just money, but I mean, it's also your family's livelihood, and you had leaned on years of experience in building your model, and then all of a sudden this model isn't working.
in this current market, and that was completely out of left field for you. So in retrospect, how would you have structured your wealth differently?
Yeah, so that's the really good question. So in retrospect, I would have done a lot smaller deals still till I could have built up enough wealth in something that couldn't redirect towards my personal wealth. Like I still would have lost the equity positions in my personal wealth, but and the mistake I made was that I could always tap my personal wealth. The next time I do this, I'm not going to have that mindset. So what I build and what I solidify in over here becomes an asset within my personal wealth position and no longer can be used to leverage into my investment world. It becomes a separate entity because what you do is, and again, it was the amplification. My ability to borrow $4 million was predicated on having, $1 million worth of equity over here, plus the equity build from the properties themselves, allowed me that access. Well, next time I'm not gonna go about it the same way. I'm not gonna put my family or my name liable. If they want to invest, they have to invest. The difference is I'm gonna lose some of the profit. I get it, because if you're bringing in investors and they're gonna come in and they're gonna be money investors instead of percent investors. So if you have an equity investor who's gonna give you the money and take a percentage of the profits versus somebody who's gonna come in and be a lender and you're going to pay them an interest rate. And so the mistake I made was, of course, the lending interest rate was like 12%. And on those deals, like it worked out to maybe 3 or 4%. Whereas if I bring them in as an equity partner, a lot of times on their money, they'd be making 10, 15, even 20%. But if I had done that in this scenario, I wouldn't have lost because they would have been just as on the hook as I was. And so again, I put my family at risk instead of putting my investor at risk. And in that, I'm learning like now when my business is built and those things are over there, that's different. But in my personal world, to protect my kids, my wife, and my family, that is a separate entity. And I'm not going to leverage from it to go into the investment world again. If you say I need your personal guarantee, you won't get it. So you can invest in this great deal and you can come in as a partner and we can work together through it. Or I can liquidate it to you and you can buy it as a wholesale asset. That's fine. We'll figure something out, but I'm not going to put my family up as collateral because that's what I did. I didn't think about it from that perspective. I put myself up as collateral. Like in my head, that made sense. I didn't think about it as I am my wife and my kids. Like that's again in my world. We're all one entity. We're not really separate, but I didn't consider that. So that would be the way that I would separate it. When you're putting yourself as an assurity to something, your family is going to be hurt if you're hurt, right? If you lose the wealth, and then if you put yourself up, well, that's tied to their wealth. And so that's not appropriate, at least in my worldview now. So again, it's just adjusting how I look at it and adjusting who and where the responsibility is. Now, that does not mean don't invest. That does not mean don't go out and find partners. It just means don't get greedy. It means if you have to give up 50% of the profits, then do that until you build enough wealth where you don't have to anymore, where you can be the lender, you can be the person who self-funds, but don't put your name as an assurity to something anymore. And that's my personal motto. I know Dave Ramsey says don't borrow debt. Mine is I'm not going to be an assurity. I'm not saying I won't use leverage, but I'm not going to be the one signing my name. Jordan Sylvester will no longer sign his name as a surety for that debt. That's just not going to happen.
Right. You mentioned previously that you did have some money in the market. Do you wish that you would have diversified your portfolio more, being not quite so heavily invested in real estate? And what happened to that money in the market? Is that still there?
No, so that money was invested in a company. It actually went under before the real estate crash. So that money dissipated, and that was part of why this is part of what gets you in trouble. Is part of my amplification process was to make up for that mistake. It wasn't in the S&P 500 and dividend stocks where I should have put it. Just so, again, one of the things I've learned is as you talk to smarter people than yourself and you really start to understand, the only reason why I don't play in that market is I'm a realtor. And for me, I understand real estate at such a high level. There's no fear in it for the most part. Like, again, I know I got hurt this time, but I still don't understand the stock market well enough. And I would have to hire a professional, which makes a lot of sense, to actually help me understand it so that I can invest correctly into it, dividend stocks and other things. Or have a friend or somebody in your world that really has that at a high level. And then you just, like I said, I just parroted a few of my buddies along the way with some other minor things, but I only had, let's say, $20,000 in the stock market, which of course was liquidated to damages to deal with other things. I had a 65 Mustang that was worth about $20,000. It got stolen out of my driveway. in August, which was fine. It worked out because then I got the insurance money and that went to, well, life happens, right? Like, and here's the thing. It was always a thing. I'm glad it wasn't my grandpa's. I'm glad it wasn't a family car. I picked it up a couple years ago for a good price. So I got it. And then I had it as a toy that I could drive. But again, in life, the whole thing I've learned is money has no value. Money is like food. It is a resource. It is something that if you value money, you're in big trouble. What you need to value is the relationships around you, because they're the things that are going to support you, whether you have money or you don't. And so again, I'm very grateful that I invested a ton in relationships. That's how I've survived. That's how I'm going to continue to survive through this. Money in a mindset is something we need. It's something you need. It's like gas in your car. Your car's not going to go anywhere if you don't have money to put the gas in. But if you don't have gas, the car doesn't go anywhere. If you don't have money, you can't feed your family, you can't do those things. But you also can't fill the tank more than what the tank allows. So you need to understand how much you need, when you need it, and then make sure you're leveraging to what your current tank, your capacity is, and not trying to get, well, I want to get to that next thing. I want to get to that next level today instead of doing the right things today so you can get there tomorrow. The greatest thing I've heard is what you think you can do in 1 year, you'll overestimate, but you have no idea. You'll underestimate what you can do in 3 years. And the reason being is you, over those 3 years, the amount of momentum you can gain, and basically you come across like this, and then you do that. There's this arc that comes in and just takes off. And so in life, the hardest part is patience. The hardest part is to just wait just a little bit. Just get yourself so you are financially independent so that you're not doing that. So yes, if you ask me, would I redivest some of the wealth? The bigger problem is I have to have boarded against equity. So most of my wealth was built in real estate. It was held in the 20%. When you do a perfect BRRRR, there was not a lot of money that came back out, and any that did usually was just reinvested. So the harder part is, and there might be smarter people where I could have pulled equity from there and put it into the markets differently. But for what I can see, I didn't have a lot of cash to really invest. Like I said, I had about 200 grand, but most of that was active for business. I run a real estate company. I run this company. I have things. So a lot of that money was in motion more than it was, call it, like in the ability to pull it out and put it somewhere specific.
Right. So moving from a multimillionaire status to zero net worth status, how has your family's lifestyle changed or adjusted?
So what's really interesting is, a lot of things stayed the same. What's changed, because most of it was held in equity, most of it was wealth that we weren't really accessing right now anyway. Overall, our life is actually maintained to some extent very similarly. My wife has gone back to work, which is not my favorite thing, but in this moment to help support, of course, I'm back building and doing those things. And that's okay. Like everyone goes through a moment in time. We've got people in support around us. So there are things we're doing that I would say are different than we were. My wife has been able to be a stay-at-home mom and do those things for most of our marriage. She's worked at different times, and I've been very happy to be able to provide that in what I've been able to do in my world for her, and vice versa. And right now she was agreeable to go back to work to support and do what we need to stay more in our lifestyle. Because that's the thing. We could revert from our lifestyle. You could step back and do that. And so like the Mustang's gone. I didn't go buy another one. Like the toys and those things are gone. But as far as like our family and the kids and stuff, we're not eating out as often, those things. But as far as life goes, life is still amazing and you get to spend it with people. And if you're having craft dinner instead of steak, honestly, I don't really care. I like craft dinner, right? Like those are the things. You're not going to be as splurgy, maybe not as many vacations. We're not going to be able to travel, maybe once or twice a year now. Well, we're going to have to travel once every 2 years or something if we want to do something, or we're going to take a drive versus taking a flight. Like you just learn how to reaccommodate your life a little bit. So that would be the biggest thing. It was one thing when I could just do what I wanted, when I wanted. If a buddy called and said, hey, you want to go golf here? You want to go do this thing? You want to jump on a plane and go away for the weekend? You want to do that? It was amazing to have that lifestyle, to have built that freedom. Now it's like you have to look at your bank account and realize, is this the moment or time? Now, the thing is, I don't plan to be here for very long. I'm just getting through the process now of being able to re-engage and really ramp back in, because again, once you have a hit that heavy, it takes a minute on your brain to get yourself through it. And again, I'm not sure I'm all the way through it yet. I think in some ways I'm on the other side. I think most of it is dealt with, but it's still heavy. It still hurts to remind yourself of the pain. But one of the things I'm trying to really learn in my life is remember the learning and let go of the pain, but it's not all the way there yet. And I think I'll get there because again, I have really good support. So yeah, that would be the biggest change I would say. Is it was really cool to be able to kind of at the whim make any decision I wanted and didn't have to really consider, well, will my family be able to pay their mortgage? Will my family be able to do that? We weren't in a month to month, or I'm not even sure at that moment. We were in a year, like the amount of money I needed to earn in a year was pretty minimal comparative to my lifestyle at that point because we had built wealth and then it disappeared. And like I said, it's okay. I would, like I said, this time I would protect the personal wealth so I would maintain my family's position, and the leverage over here could only ever add to it, but it could never draw away from it again like it did.
Thanks for sharing that. I think you have a really optimistic view, a realistic, optimistic view of the future. So where do you go from here?
So from here, I went back into transactional real estate. So actually what I realized was, why not just go do the thing that produces constant paychecks? Because right now, again, when you need a constant paycheck to pay the constant bills, you need to be in a more of a mindset about the immediacy of money and not the, okay, I'm going to do this flip, I'm going to make 80 grand. I'm going to do this flip, I'm going to make 30 grand. I'm going to do this flip, make 50 grand. And like, you're making massive chunks, but you're doing it quarterly more so than like transactionally monthly. And I realized in the moment to go back into my highest leverage, which is my real estate business, and just really ramp into there. So I've done social media, I've gone on the podcast, I'm doing a lot of things to really amplify my brand. And I'm, again, not that I will not be investing, but right now in the current economics that I see in front of me, this is the best model, which is real estate sales. Because people are going to be transacting, they're going to need support in that arena. Real estate investing is still sitting there. There's opportunity, of course, through wholesaling and other opportunities that could present as we move through the next step. So I'm just positioning myself mentally. I'm positioning myself emotionally to be the best realtor I can for my clients, to make sure I show up with that being the primary focus over the next phase of my career. I'm building a team within the team. So I'm part of the Verge real estate team, but I have my own admin and I have my own media guy that I'm working with to help re-solidify, and we'll probably add a realtor once we build enough stuff. So I am going to try to move myself back to where I was, but I'm going to do it with a better engine running underneath than just the luck of the flip, right? Because I kind of leaned over there and walked a little bit too far away from the constant real estate business, realizing that when all of a sudden that stops, you still need an income, especially when you lose all your wealth. And so this time I'm going to build a really strong engine that can't really be stopped, because no matter what the circumstance, real estate will continue to transact. And then whether it's a great investment moment or whether it's time to shelter your funds and wait for the great investment moment, I'll be able to do that more easily if I have a better engine in the constant transactional business. So my focus right now is highly real estate transaction. And then, of course, if there's great investment opportunities or there's things around that. And like I said, this time though, I still have a lot of business partners that want to invest. They always call me. They're always like, hey, like I said, I've been a little trigger shy. I think once I get myself right on the other side of this and I can see myself and my family back and moving in the right direction and in total optimism, I would say right now I'm pessimistically optimistic. Like, I don't even know if that makes sense, but like there's a part of me that's still very cautious. But I know once it's like getting behind the wheel after a car accident. The sooner you do it, the better it is, because the longer you wait to get behind the wheel again, the harder it is, because the more fear you build up about that experience. And I'm being cautious with that mindset.
Wow, what a journey that you've been on. I appreciate you sharing all the details and the mindset behind everything. Let's wrap up with some rapid fire questions. What's the most expensive pair of shoes or pants that you purchased?
The most expensive? That would have been a long time ago, but they were $350 and they were skater shoes when I was a kid.
Okay. What about the most expensive meal out that you paid for?
Most expensive meal I've ever paid out was, I think it was $3,200 downtown Toronto at one of the at High Steakhouse. It was, we asked, what's your most expensive bottle of wine? And then we didn't actually buy that one because that one was like, I think it was like $3,600 or $3,700. I'm like, never mind. So we still like, we did some steak. Like the meal was for 4 people and it was $3,200. So about $800 I had that night. But most of that was, I think it was 3 bottles of wine, and each of those was relatively maybe in the $1,000-ish bottle pricing, because we were just celebrating and having fun way back when I was a kid, and I didn't have kids and call it I had a lot of expendable income back in the day, and I wasn't overly bright with it. I didn't invest like I should have and put it into some stocks.
Okay. What about the most expensive car?
Most expensive car at this point would have been so the most expensive car is probably the one I'm driving now. It's about $65,000. It's my GMC Canyon that I've got right now is the most expensive car I've bought. But if everything had gone differently, the most expensive car I would have bought would have been, I was allowed to spend 20% of what I should have earned before the market crashed that year on a car. And I was looking either at the Audi R8, as if I made $1 million was basically the car I was looking at. And then if not, it would have been something to the tune of the high end Vet was probably, I like fast cars. I like agile cars. So I've driven those cars, but I have not owned those cars. My plan is still to one day go get one of those. So.
Okay. What about the most expensive trip or bucket list experience that you've done?
So that was actually, we just did that. We used a lot of points, but the overall trip probably cost about $8,500 US just for me and the wife. We flew into Vegas, rented a car, drove down to La Quinta, California, hung out there for a few days, then drove down to Mexico. Came back. We went to San Diego, stayed overnight in Carlsbad, drove to see some friends in Yorba Linda, and then went back to La Quinta for a week, back into Vegas. And then we hit up the Grand Canyon, hit up Hoover Dam, gambled a bit, and flew back out. So cash out of pocket, because I have a lot of points, was probably only about, let's say, $3 or $4 grand, but total trip cost was probably about $8,500.
That sounds like a pretty sweet trip. And you were gone for a couple of weeks?
Yeah, we were gone from a Thursday. We flew in on a Thursday, got into Vegas like at 10:30, and we flew out on the red eye from Vegas again at like 11:30 on the fall, like 2 weeks later, Thursday. 15 days for 15 years. So
okay, hey, I like it. You go on a 15-day vacation for 15 years. I might have to take a page out of your book on that one. We got our 10th coming up, but
there you go.
May not be 10 days, that's for sure. We'll have to push it to next year, maybe.
Yeah. Well, yeah. The little ones are on their way.
Yeah, exactly. What was your first job?
First job, I worked as a bike builder at Canadian Tire up here. So I built bicycles, put them together in the back because you could do that without being on the floor because I was too young to work on the floor.
You remember how much you made?
I made $7 an hour.
Okay. What's the dumbest thing you've ever wasted money on?
Probably. What's the dumbest thing I've ever wasted money on? That's a really fun question. Like I can come up with a lot of answers, but I would assume it's probably partying when I was young again. Like nights where you'd go out and get bottle service and go like get the limo. Like one of my buddies was a promoter back then. Like the amount of money I spent when I was young and dumb was insane. Like, and again, in context to the amount of money, I've been way more responsible when I was like actually finally had money again. I think that's how you get to wealth is you live within your means. Back then I just blew everything I had, every weekend to have fun and party it up and live a lifestyle. Like you're trying to be something. So I think in one weekend I blew over 5K. Between alcohol and partying and doing some dumb stuff. So to me, that's not worth it now. It was worth the experience when you're a kid, I guess. I wouldn't recommend it to my kid. Like I wouldn't tell my kid to go do that. But again, that's probably like the dumbest thing I've ever really done with money at any major scale. A lot of other random stupid purchases along the way, but just like things you think you need and then never use, right?
Yeah. Okay. What's something that you spent way too much money on, but you don't regret it?
Way too much money on, but don't regret it. That would have been the Mustang. When I paid 20 grand for the 65 Mustang, we're in Canada, right? So you can only drive it a few months of the year. That thing was worth every penny, and I don't care that I paid what I wanted for it. Like they're like, oh, you could have paid 10 or 12. I'm like, I don't care. I have a Mustang. I have a 65 Mustang in my driveway. I don't care how much I paid for it. I'm just happy to have that car. It was a great car. So for me, I know I don't have it now, but that was the thing when I paid for it. I was like, yeah, let's go. So because that car was fun.
On a scale of 1 to 10, how would you rate your love for your career / profession?
Probably an 8. To be honest, as a transactional realtor, I view myself more as a businessman. So I like the concept of running a business more than I like the concept of the constant day-to-day in a business. But that I do love this job because it really is just helping people. It's not sales. People think real estate sales. It's not. It's really just, it's more counselor. You're dealing with people in their toughest moments. A lot of the time you're dealing with death, divorce, you're dealing with first-time home buyers, you're dealing with all these people in their moments. And so I really love that about the job, but I really hate compliance and paperwork. So there's a balance to the job that,
For sure.
There's always something about it that if I could get rid of all of that, then I would do the other parts. That's the best way. And that's what I am attempting to do. So then I could love my job and not worry about all that stuff.
Okay. That's pretty good. What's the most fun that you've ever had with money?
Most fun I've ever had with money. So probably actually going to Windsor Casino again. It's always because it didn't matter. So it was easier to lose money and not care. But we went out one night and me and my buddy went to the casino. He was up like $4,000. I think I was up like $3,200 back then. And so again, when you're young, that's a lot of money. And so we went out that night. And so of course you have all this money, you go out, you have a great time that night. So we went to the casino, made a bunch of money, went out downtown, had a great time buying drinks, doing the whole thing. But it wasn't a night where we all got like lasered. We went back to the casino later and and by the end of that night, it was just such a cool experience. And we just left and it was like, man, let's do that again. And then of course you go back to the casino and you just lose your money because that's what happens the next time you go. But that night was great because we both were up. It was a great night. Everything was happy. We were hanging out with it's like the good old days with the crew before life got complicated, before everything became, before you actually understood what it meant to be an adult, even though you were technically one, right? My son just turned 18 and I'm like, man, you're at the greatest time in life. Now you think you know everything and in a few years you'll realize you know nothing. It's great. You're just at this weird moment, but that was an awesome time. We made a lot of money. We had a lot of money. We were doing whatever we wanted, going wherever we wanted. We could, that it's a cool thing to be able to spend money that way.
Yeah. What's the craziest thing that you've ever done to earn money?
Craziest thing I've ever done to earn money. So the craziest thing I've probably ever done is like do some jack bet where I used to show off. Like I like to, I was agile. I was pretty athletic as a young man and I could like run and jump off things or jump over things. So probably it would have been like a stunt where I was either trying to jump over chairs or jump like across a stage or do something where, and then my buddy bet me $20. Like it wasn't like, I'd probably do it for free just to show off, but the bet just made it worth it. And so those would be the best money I've probably ever made is off of some dumb bet with one of my buddies to do something like jump this fire. That's the one where I almost didn't make it, but I jumped clearing. We had this we were at a farm. Now that I'm remembering, somebody had thrown like this extra set of stairs that they had. So it was like up on an angle. And so they're like, wow, like I dare you to jump it. I'll give you, whatever bucks or whatever it was. And so I'm like, all right. So I went to jump it, but I just caught the top of that stair with like my foot as I was going over. And so you kind of go to fall. And so as I landed, the one leg just landed kind of at the edge of the fire. I was fine. I was like, whatever. I'm a kid, man. I'll be okay. But that was probably one of those, hey, that was a good $20.
Yeah.
Could have lit myself on fire, fell in the fire. But
wow.
People, when you're young, you're not the brightest.
What's a key lesson you learned from childhood?
So I'm the oldest in my family. So again, one of the lessons I learned was like, the responsibility part, right? It's like you got these kids that aren't your kids, like they're your siblings, right? But as the oldest brother, you get this great opportunity to really be in their world. And so when I look back and think about that, it's that security or that ability to be their protector. Was a really cool thing for me as a young person to look back and recognize it. Like that was part of what I did for them and kind of cool to think of yourself that way. Like, again, I don't think of myself as somebody who's going to go drop gloves with any random person, but I also like to think about myself and remember myself as a person who, when push does come to shove, I will protect my family. I'll take care of my siblings. So,
okay. What's a closely held belief that you once had that you recently changed your mind on?
Wearing a seatbelt. So I didn't for a long time. One of my best friends was killed years ago. And because of that, I know I was wrong data. Like I know intellectually I was wrong, but because of that experience, I wouldn't. And I told my kids too, just so we're clear, like I've never told anyone else don't do it, but I didn't. And I actually only started to wear my seatbelt when I got this new truck in August. And so I put it on and I finally was able to move past, call it an emotional hiccup where the other two guys that were in the car wearing seatbelts, they were ejected, they lived. My buddy who was killed. And so I get it's not logical, but it's it's probably the most wired experience in my brain, the most angry I've ever been in my life, the most upset. And so that wired in something that was very dangerous for me, right? Like it's not, so that would be the one of the major beliefs that was massive to change. And now I do it out of habit already, right? Like it's interesting because I did always believe it to be the right thing. I just had an experience in my life that told me it was more dangerous to wear a seatbelt than not. That wasn't true on data. It was just true in my worldview, I guess, is the best way maybe to describe that.
Yeah. any final piece of advice that you give to somebody who's just starting out?
Remember, you're going to make a lot of mistakes, and it's okay. Take them as learning. Don't take them as failure. Don't think, oh man, I made all these mistakes, I'm a failure. Think of it as like, nope, you're just taking a page out of learning. When you started to do math as a kid and you wrote your first math test, how many did you get wrong? Now, how many did you get wrong when you wrote it for the third time? Okay. It's going to be one of those things where you're going to make some mistakes along the way. You're going to learn. The best way to help yourself avoid some of those mistakes is find someone in your world that you can lean on for advice. But even when you lean on them for advice, they're not going to, unless they do all the work for you. If you're going to do it yourself, you're going to make mistakes along the way. Just let yourself learn from them, move on from the emotion, and don't feel like a failure. Failure is learning unless you actually live in it.
Awesome. That's Jordan. Net worth, I guess we're at 0, but you were at 2+. Going to be back there shortly. Thanks for coming on the show today.
Thanks so much, Jason. It was awesome to be here. Thanks so much for having me.
Thanks for listening to the Millionaires Unveiled podcast with Jace Mattinson. For more stories, investment opportunities, and information, check out our website, millionairesunveiled.com. See you next time when you'll hear from another everyday millionaire.